Hi, I'm Seth Freuberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. And this week, I'd like to talk about long-term trades versus short-term trades. Long-term defined as trades that you start 8 to 10 weeks out. Short-term, maybe you start those 4 to 5 weeks out. And what we are noticing this year on our trading desk is that the traders that are doing the following, they're entering trades, let's say, 8 to 10 weeks out, and they're closing the trades 4 to 5 weeks out, and rolling their capital over into another 8 to 10 week trade. That's what I would call, long-term traders. Those traders are doing much better this year than the traders that are working with shorter time periods. And it's pretty easy to explain why. It has to do with something called gamma, which is the rate of change of delta. And delta is the reaction that an option has to price movement. So essentially, this year was a trickier year for options trading, or market neutral options trading, which is the style we trade on our trading desk. It was a year where there were dramatic sell-offs followed by even more dramatic rallies. So we got whipsawed very severely a couple times during the year, which is very difficult for market neutral strategies to handle generally, but it's a lot more difficult for high gamma market neutral strategies to handle than low gamma strategies to handle. And the low gamma ones are the ones that are sold farther out in time, or are entered into farther out in time. So let's just take a look at the 2015 SPX price chart, and what you're going to see is that 2015 was actually one of the more calm years on record. And you can just take a look straight through from January, which is to the far left of the chart, all the way into I think it was October. There was a very, very mild year. Then there was a couple of months where things got a little testy, but ultimately the market started to calm down again towards the end of the year. So that was a year where people who had low or high gamma trades did really well, and that was very, very much the case on our trading desk. But 2016, it was a much more erratic year. You can see at the beginning of the year there was dramatic sell-off in the market due to the price of oil, and there were also problems in Asian stock markets, particularly the Chinese stock market. And then there was this dramatic, very quick rally that came off the bottom of that. And then, of course, in the summer, we had Brexit in late June. So you had this big sell-off for a couple of days and this monster rally that took place after that. And so we had two very, very sharp V-shaped whipsaws occur, and it made this year much rougher to handle than 2015 if you were selling high gamma types of trades, which are the ones that tend to start closer to 4 or 5 weeks out from expiration. And those trades are going to struggle more, particularly in a pattern that was occurring this year is right before expiration, maybe 7 to 10 days out, we'd get a big move, oftentimes a rally, and that big move just was problematic, to say the least, for a number of our traders. So let's take a look at the risk graph of a low gamma trade, and you can see that if you start far out in time, you're going to get a very flat T+0 line, and those flat T+0 lines mean that if there's a gigantic price movement, the implications on the trade are going to be much less than a trade with high gamma. So these are the exact same strikes 51 days out, and now we'll take a look at it 2 days out. That chart looks a lot different, doesn't it? That risk graph looks a lot different. And the reason it looks so much different is gamma 2 days before expiration is astronomical, and so the rate of change of delta is very, very high, and that's why you get much more risk. As you can see, this is a very risky risk graph. If the market sells off, you're going to do great. If it rallies, you're really going to get hurt. So I just wanted to show you an example of both a low and a high gamma trade to give you a feeling for how dramatically different these two kinds of trades are. These are outlier examples, but still gives you a feel for the concept. So what's the takeaway from today's discussion? And that is our trading desk now contains a mix of traders, some of who start their trades very far out in time and others who trade closer in time. And both can be very, very successful strategies, but what we're finding is by having a mix of low and high gamma trading on our desk, it's an ideal blend. And so you can interpret that any way you want to, but for your own personal trading, if you want to have that same blend, you could select a strategy that is started, say, 30, 35 days out, like our hard-friendly butterfly that we utilize here at SMB, or you could go all the way to the other end and do like a road trip trade where that one starts 10 weeks out. And you could combine those in your portfolio and have some diversification of gamma, which means that whether it's a choppy year or a more flat year, you'll have an answer for that within your portfolio of trades. So that is a healthy mix, and it is something to consider for your own personal trading. Now, the elections are coming up in a couple of weeks, and you may be thinking about this, and some people are concerned that there's going to be very high volatility approaching the election. And that may be. We may get high volatility, we may not. There's no law out there that says we will get high volatility coming into this election. But if you have a big concern about that, my recommendation would be that you trade the longer term trades through this period. And so instead of putting on a November trade now, maybe you'd put on a December trade or even a January, like someone did on our trading desk a couple of days back. So that way you can have the very flat T+0 curves. You can still be collecting some theta during the election period, but you're not so much subject to the high gamma situation, which could get kind of interesting around the time of the election. So something to think about. I know personally I've been starting to scale out of my November trades for this exact reason. I'm not terrified of the election, but I think there's a possibility that we could have some increased volatility around that time. And so it wouldn't be a bad idea to be in a much lower gamma posture around the election. I think that's pretty good advice, but you may see it differently, and there may be not an increase in market volatility during that period of time, in which case being in a high gamma trade would have been better for you. I'm just saying that it's something to consider if you have the concern about volatility in the market surrounding the elections. So just a thought for the day, and we'll see you next week. Thank you.